Good morning to folks in North America. Good afternoon to those of you in Europe. And if we have anyone staying up from Asia, good evening. I'm Janet Van Alsten, and I am your moderator today. I am a program director with the Conference Board, and I'm coming from you live from the shores of Lake Michigan. Now today, we have as our presenters Kathy Luce from Aon, Carl Redondo from Aon in the UK, Jesse Parker from Cypress Shaw, and as you can see, we all have either our COVID hair or our COVID beard, so we don't quite look like our little pictures, but I welcome you all to our conference today. This webinar is part of a sponsored series by the Conference Board and our friends at the American Benefits Council. For those of you who aren't familiar with the American Benefits Council, they do a great job of advocacy for the comp and ben community in DC. Also, these webcasts are in collaboration with the two law firms of Cleary Gottlieb and Cypress Shaw. Now today we're going to be talking about corporate governance for comp and ben. Jesse will be talking through that. We will be talking about implications of COVID-19 in the total reward space and how the strategy may have changed and how we can manage the workforce in an appropriate fashion. And finally, we'll wrap up with Carl talking about strategic and tactical processes for comp and ben programs stemming from this crisis. A little bit of housekeeping first. For those of you who are interested in continuing education credits, depending on what your variety of entity is, HRCI, you have some instructions there to enter HRCI. For SHRM, you've got your instructions. And then finally, for those accountants out there, a little bit more difficult work to get your CPE credits. So if you are interested or need those continuing education credits, please take note on how you get them. And finally, in order to get the full educational and interactive benefit of this webcast, you can ask questions in the lower left-hand portion of your screen. You can type your questions there, and I will pick them up and ask them of our council members. You can download the presentation. You can see the little arrows up there on your screen if you want to view in full mode. And finally, this webcast will be recorded, and you can share it with your colleagues at a later date. So, and finally, if you can tell us about your experience, we can improve these webcasts as we go. So I am going to turn this over to ask questions and have Jesse address various employee considerations when seeking to change comp and benefits, both from a global perspective and kind of looking at the governance and legal issues associated with that. So, Jesse, take it away.
I'm coming for you live and direct from Scarsdale, New York, so we are kind of all spread over the country and the world here. So the first point here you'll see on this slide may seem like an obvious point, but in fact it's something that really needs to be given a lot of consideration, and that's we have one problem that needs to be solved, but when you're taking a look at it from a global point of view, the solution's really not gonna be the same everywhere. so oftentimes, I am by trade, I'm an international employment lawyer. And so often I'm approached by clients where a client will say, well, here's what we need to do. And we're going to do it all over the world. And it's a simplistic view. And yes, that in an ideal world that would be possible, but you're not going to be able to do everything. You're not going to be able to follow one specific plan, and certainly not be able to implement it everywhere in the same way. And I'll share a little anecdote. About a month or two ago, well, I guess it was about 2 months ago, we were approached by a client who said, because of COVID, we need to cancel our annual merit increases. And we had already communicated in February to our employees that they were getting their annual merit increase like we do every year, that were to go into effect in May. Now, of course, at the beginning of February, the world was in a slightly different situation, and the financial situations of companies were very different than they are now. So the client came to us and kind of said, well, we need to cancel these, and we're not going to get consent. We're just going to do it unilaterally. My response was, okay. Anytime I hear something about changing terms and conditions unilaterally, a red flag goes up, because that's obviously not something very easy to do. But my other question to them was, well, what countries are we talking about here? And it wound up being literally countries all over the world. So what we really did was come up with a communication plan, country by country, which took into account kind of sensitivities around, what the laws were in those countries, the ability to change these things, and also kind of advise the client about the risks that existed in every one of these countries. If this was the approach that they wanted to take. Of course, it was the approach. They didn't back off that. So we kind of created this very detailed communication plan. In some countries it was a little softer than in others. Maybe we sought an acknowledgement of receipt instead of consent, but we kind of devised this plan, and it wasn't a one-size-fits-all solution. But so far so good. We haven't gotten any pushback yet. But again, it's just kind of an example of kind of how you need to really approach this on a country-by-country basis rather than look at it holistically, take a wide-ranging view on it. You'll see here the next bullet it says benefits will become more valuable in the eyes of employees. And I think, we're certainly already seeing that. Employees are paying more attention. We expect it to be even more so, that employees are really more concerned about benefits, right? They want to make sure they have health care. They want to make sure that their families have health care coverage. They want to make sure they have death and disability coverage.
Jesse?
Yes.
Is this something that you're seeing regardless of the type of healthcare system the country has?
Well,
in terms of universal coverage?
Yeah, well, I mean, obviously countries where state-sponsored, where you have state-sponsored health benefits, or where risk benefits are mandatory. If a country's practice, if a company's practice is not to provide supplemental benefits, or if it's not generally a standard practice to provide supplemental benefits, there's not much that can be done there. But where supplemental medical coverage is kind of common, or where life and disability are also, supplemental life and disability are also kind of options that employers can provide. we're seeing a closer scrutiny of that, and kind of that playing a larger role in negotiating packages, right? Whereas, you know, before, you know, cash is king. So when you're negotiating with, you make an offer to a new hire, right? You know, and you offer your benefits package, an employee will see that benefits package, and generally, you know, they may ask some questions about it, but it's not usually a negotiating point because, you know, companies have their benefit plans, and there may not be much variance or ability to adjust those. But I would expect to see that yeah, cash will still be king at the end of the day, but I would expect that we're going to start seeing more questions and kind of more interest in supplemental medical coverage, supplemental health and risk benefits as well, and even leave, you know, child care leave, parental leave, those types of things are also going to become greater in focus as we see, you know, yes, things seem to be clearing up now, but I think we all expect that there's going to be an inevitable second wave of this. And the longer this goes on, the more companies are going to need to pay attention to what their benefit packages look like, and where, if any, they have an opportunity to kind of make them more appealing to candidates.
Yeah, and I think Jesse, I'll cover some of this in a bit of detail in terms of the benefit changes we're seeing as we.
Yeah, go ahead, Carl. Carl, did you want to interject something?
I think there's a delay actually. I was just saying I will cover in some detail the benefit changes that we are seeing in the market.
Another really important thing to consider here, because inevitably companies are going to try, you know, they're going to be looking to make some changes, right? The economic landscape, companies are going to be looking to cut costs. It may be, trading one benefit for another or an increase in salary. But what companies really need to understand is what is the basis for that entitlement for the employee? Why is it that the employee receives that benefit or that compensation? Is it under statutory law, an express contractual term, an acquired right, which basically means something that's kind of become quasi-contractual through the employer's practice over time, or a collective agreement. Now, if it's a statutory law, there's really going to be very little wiggle room, right? Unless there's a change in law, which we are seeing that countries are kind of implementing these interim measures or emergency decrees to kind of, one, protect employees, but also free up companies to kind of adjust things to enhance their ability to survive. Express contractual terms and acquired rights, they're largely going to require employee consent. And then collective agreements, you're really going to have to look at the collective agreement and figure out how, under that collective agreement, what the process is for making the kind of change we're talking about. Union and works councils, not a concern so much in the U.S., but outside the U.S., particularly in the EU and in Latin America, unions and works councils are heavily involved in regulating employee terms and conditions. You're going to want to understand exactly, what the process is. Does the works council or the union have co-determination rights? Meaning, will they have to approve any change? In a country like France, oftentimes a works council will be afforded the right, or they have the right to offer an opinion on any potential change. And while while that doesn't necessarily mean a company's bound to follow the Works Council's opinion, it does need to be taken into consideration, and it can't just kind of be, just a like kabuki theater. There does really need to be real, genuine negotiation and listening to what they say, or is it just kind of a right to information? In which case, you'd need to just inform the Works Council or the union about what it is you're looking to change. Here, so challenges, that we expect to see employers facing, and the obvious one is, look, companies need to find a way. Are all companies? Look, the first 2 months of this pandemic, right? All of my work was cost-cutting work, right? Companies wanted to know how can we quickly find ways to save money. Even if they didn't need it in the short term, they're realizing in the long term that, look, we may not be feeling this impact in Q1 or Q2, but it's in Q3 or Q4 when actually things may start be returning to normal a bit, is when we're really going to realize the financial impact. So, how are we balancing this cost cutting in a way when employees want to actually enhance their benefits packages? We saw, initially we saw furloughs and layoffs, obviously, as the kind of the quick fix, and in some instances, while it's kind of counterintuitive, a furlough and a layoff in a lot of countries is actually easier to implement than a change to a term and condition of employment. Again, depending on what the source of that term and condition of employment is, it may actually be easier to lay off someone or furlough someone than to reduce compensation or eliminate benefits. Another thing that I think is important to realize here, and I'll bring you back to the example I started with my client's unilateral decision to unilaterally change comp and to put a hold on their merit increases. Oftentimes, and particularly in the current pandemic, you won't necessarily see claims being brought by employees for changes to terms and conditions at the time those changes are made, because oftentimes those changes are going to, these changes are going to require, to bring the claim, a constructive dismissal claim, an employee is going to have to resign from employment. And in the current landscape, an employee's, if you're telling an employee, hey, you're not going to get your 4.5% raise this year, but you're going to get to keep your job, at the time that's going to sound great. And even if you're not happy, you're not going to give up your job in order to bring a claim for that 4.5% raise. Where you're more likely to realize the risk is 2 years from now when you actually have to terminate that employer or make them redundant. And then they go looking for all kinds of claims, and depending on what country you're in and what the statute of limitations is for that claim, we really do expect to see more claims being brought in the next 2 to 3 years upon termination for changes that employers may have implemented during this pandemic. And then just one final point here that I wanted to highlight, and it's really about collective representation. We're talking a lot about changing terms and conditions and really kind of affecting employees' rights. When you're talking about those kinds of things, works councils and unions kind of are licking their chops at the opportunity to kind of move in and protect employees. So I would expect, companies want to be careful. If you don't have unionization and you don't have works councils, but you're otherwise in a country where where works councils or unionization is somewhat prevalent, and you're planning to kind of put in these changes, you're going to want to also try to create some kind of a plan to counteract any union or works council trying to seep into the workplace. You know, local lawyers, myself, we work on these kinds of plans all the time as, you know, a best way to approach employees without kind of opening the door to these, you know, employee representative groups moving in. You know, because of the impacts we're seeing here on employees and employee rights, I would not be surprised to see an uptick in unionization and collective employee representation going forward.
Very interesting, Jesse. I have to wonder what my Dutch colleagues would say about that, who have very close relationships with their unions.
Right.
But anyways, I'm going to move this on to have Kathy address some of the total rewards challenges. And Kathy, right off the bat, I got a question from the audience about how companies are addressing home office expenses, and for all these people who have been sent home, how are companies addressing any additional compensation for them?
Okay, yeah. Thank you, Janet. And that's a great question, because usually that's one of the first things that organizations are trying to assess and then make the determination, particularly when you have a larger population now that are working virtually. We did a number of survey, a pulse survey, in terms of identify what organization, what action have they taken so far. And companies are definitely putting in place a number of assistances and support to the workforce. Some of the key changes or action that companies have implemented, probably one of the most prevalent, is cell phones. You know, I think a lot of the organization now, when you think about it, all of us company provide cell phones. That's not necessarily true, particularly for workforce that are more, you know, doesn't require a lot of traveling or a lot of interaction with clients. But cell phone is one of the elements that organizations now are providing more to employees. In addition to that, to really provide, you know, some type of what we call a one-time allowance to allow the employee to set up a home work, you know, home office work, for example, purchasing a laptop or monitor. Typically, an organization would put in like what we call a pre-cap limit. And the amount ranges anywhere from $150 to $200 to allow employee to set it up. The other item that we've seen is to allow employee to expand in terms of internet capability and landline. So these are some of the most prevalent activities that we have seen organizations have put in place to support employees. And we don't see that going away, because this is something that I will talk a little bit later on about how all of this is changing the workforce strategy and pushing, you know, increasing more and more in terms of virtual working environment within the overall workforce.
Yeah, and something else along those same lines, but not quite this as far as expenses, but companies also need to keep in mind health and safety, right? As we start to see the workforce shift more and more to remote and working from home, there are a lot of countries that highly regulate health and safety, even to the point where if you have a home worker, that there needs to be some kind of an inspection of the home office working environment to make sure that it's a safe working environment. As kind of ridiculous as that sounds, it's not entirely uncommon and unheard of that this needs to occur. You know, particularly I believe Germany has you know, where employees are formal home working employees. I do believe there's some kind of a requirement to make sure that the home office is a safe place to work. So So companies that aren't necessarily well versed, maybe don't have large operations internationally, or maybe they don't really have previously didn't have a large remote working population. They're going to want to make sure that any kind of health and safety requirement is complied with in the new home working environment.
Yeah, no, it's a good point, and I think that's something that maybe Carl can address a little bit in terms of, from a long-term basis, how is it going to impact in terms of the health and safety regulation, and that means defining whether your home office now is qualified as a workplace, and in that case, what kind of standards. So, yeah, good point on that one, Jesse. So do you want me to go in terms of from a compensation, Janet, a little bit further?
And talk about how your Aon framework works, and then head right into compensation and benefits.
Okay, perfect. I only have a 2 slides, so what I want to do is really talk about, we within Aon identify what we call the pandemic crisis management process, a model. And the key one is really looking at, number one, there's 3 phases. The first one is talk about react and respond, really managing the crisis. The second phase is about recover, in terms of trying to really stabilizing, in terms of the business, and then looking at how to come back, right, in terms of trying to resume some type of normalcy. And lastly, talking about reshaping and planning for the future. I think there's enough information, and already we know what had already happened in the phase 1. So I won't really focus on that. What I will touch a little bit is on the recover, but also now really putting more emphasis on the reshape, planning for future, and what we have seen so far based on some statistics and information. So when you're looking at, and the next slide, and I'm assuming, okay. So when you're looking at this, putting into kind of macro context and nail it down to specific actions and things that organizations are doing, what we do is we show here is from an overall compensation and workforce planning, some of the key consideration and action companies have putting in place. And we identify it more like looking at from a quadrant kind of perspective. You're looking at in terms of the horizontal, here's the impact time frame, and that's looking at the short term, in terms of react and respond, and now moving to the midterm recovery, which is about more than 65% companies that we've surveyed so far have indicated that's where they are right now. And then looking at from the long term, the reshaping. And then on the upper, in terms of the vertical side, you will see that what are the impact, the level of actions, and the degree of the impact, starting from the bottom, which is low, all the way up to the high impact of organization. So I'm going to just go right in and focus on the midterm recovery, and because that's where we see most organizations are focusing on now. And then what are some of the key action and consideration from a long-term perspective. So when you're looking at the midterm recovery, some of the key things that we have seen either organization have taken or are seriously considering, starting from the lowest impact, and that means looking at eliminating some of the non-essential or discretionary perquisite and benefits. We're not talking about the core benefits, which Jesse had touched on how critical they are, but these are items that company really have a more discretionary kind of decision and be able to reduce accordingly, such as training, travel, entertainment. So these are some of the aspects. The other one is really shifting to a more flexible working hours for employees, particularly the one with the young children, obviously because of the fact that most of them, are now homeschooling. The other item is looking at putting some type of lump sum payment increase in lieu of salary increase. One of the caveats I just want to highlight as we go through looking at some of these considerations is organizations are very mindful of the legal pitfalls or the impact as Jesse highlighted earlier. And so where it's allowed, because very much depending on the country, that's where some of these actions are in place. So these are some of the low impact in terms of activities. As you move up, in terms of the spectrum, looking at from a moderate, we see that organizations are now focusing a lot on readjusting and modify the incentive plan performance, and really looking at, and I know that there was the early questions about what companies are doing regarding STI. So you've seen that modified, incentive plan funding, particularly addressing the performance, the threshold in terms of the, suddenly the slide's gotten very low, very small, so I'm looking at that. Really trying to adjust a lot of this, but that's also including, revisit again, not necessarily changing the STI in terms of plan design or framework, but readjusting and modifying in terms of performance expectation as well as the funding level. Other things that include,
I wanted to go back to the low impact, because I haven't encountered that at all, but it's an interesting idea of
right.
providing a lump sum payment instead of a merit increase. When do you know how have companies gone about doing that? Are they, is it a consent? Again, obviously, understanding the framework of where the benefit, the entitlement is from, but merit increases
right.
are generally not contractual, right?
Correct.
So
yep.
how are companies just saying, "Hi, Jane Doe," or a group letter? As you know, we're under financial strain. We're not, the merit process isn't going as, it will not be run the way it usually is, and in lieu of a merit increase, we're providing a one-time lump sum payment. Like, is that basically what you're seeing clients do?
Yeah. Lump sum payment is not an unusual concept. Organizations probably in the past have implemented some type of measure like that, particularly as a way of recognizing the high performers. And so this concept now is expanded a little bit further, is instead of providing a merit increase, and I'm not saying that companies are eliminating, to the extent that it's possible, organizations really very conscious of anything during this time, you want to reward and recognize the high performers. And so the lump sum payment often is used as a vehicle of rewarding, the very high performer, recognizing that you might not be able to provide a normal salary increase, the merit increase that you've done in the past. We have not seen an organization completely eliminate merit increase because of this recognition, but we've seen organizations trying to be, I would say, more creative in terms of, on the one hand, be able to manage the budget, effectively, but on the other hand, continue to reward employees. So lump sum approach is one way of doing that.
Are they trying to tie in retention to that? Is it like a retention bonus, or will they seek to get new restrictive covenants or something? Are they trying to get something for that?
It's not retention bonus. I think it's tied in more to performance, recognition of performance. And so that's help in terms of providing, a kind of one-time cash recognition, particularly during this difficult financial time. So that's more in terms of performance recognition. Retention is really not, I think if you look at more long-term, it could saying that it could help, but that's generally not the main objective.
Kathy, I have a question here with respect to merit increases. Many of our member companies who are on calendar years are looking at salary surveys and what to do for next year. And they're finding that a lot of the data is not reliable. Can you address that on what your clients are doing?
Great question, Jenna, because we have seen, this question had come back to us quite a lot, because as you know, most of the salary increases were finalized in late fall, right? And then that's already provided what the budgeted merit increase percentage would be for 2020. Of course, no one expected or forecast this could happen. So the number, the percentage that we've seen can be said that it's maybe outdated and not really, relevant to the current environment. So what do organizations do in that? What we have done is that we work with a number of clients, and what we've done is we say, let's take a look at the usually salary budget increase. To put that together, company would look at each of the country in terms of GDP growth, inflationary rate, as well as unemployment, and tied all of that together. And so when they look at that, we're also saying, let's go back to the historical previous crisis, not similar, but at least give us some kind of historical precedent to help in terms of making the adjustment. So what we have seen so far among organizations is that there's a recognition, again, to the point Jesse was asking earlier, that we need to continue to reward and recognize. So we have not seen the organization completely eliminate a merit increase budget. We've seen one is the one that still have it in place is delay and defer any kind of merit increase. Secondly, to adjust it and usually adjust it down by anywhere between 1% to 2%, but still have a pool, reserve to recognize some of the high performers. And that's what we have seen so far, and that seems to be pretty consistent at the global level. And then on top of that, maybe introduce some lump sum in terms of a small pool for lump sum payment on top of the smaller merit increase. Thank you. Okay. Yeah. So, if I go back, and I just want to move quickly in terms of, the rest. Obviously, the top in terms of midterm recovery, key action are laying off, the workforce. And that's including kind of workforce reduction. That's a drastic, in terms of action that we've seen. And we have not seen organizations, that done as much. I think we've seen the impact primarily in smaller organizations, smaller company that is facing, tremendous financial difficulty. We also seen certain industry more heavily impacted, such as airline, hospitality industry that are taking some of these actions. But we've seen organizations are definitely much more conscious and really evaluate and use this as a last alternative in terms of as part of reshaping and restructuring the organization. We also seen that there are some possible consideration in terms of cancel some non-statutory base salary adjustment. Again, this has not been what I call the most prevalent in terms of action so far. I think when you're looking at what's happening in today's world, there's a general holistic, in terms of approach by company, in terms of trying to survive, recover, but at the same time, providing some support to the employees. So that seems to be a kind of effort that we've seen consistently across all of the organization in the industry. And so these are some of the aspects that we've seen organization as you go through. One other thing I want to mention about is we, throughout this whole pandemic, the crisis, the timeline, we conducted, this is our fourth pulse survey, just kind of gauging organization reaction. And we have seen quite a shift, within a month period in terms of some of the things that organizations are putting in place. We've seen there's definitely more efforts or consideration, if not already in place, in terms of adjustment to FTI goals. We also see more organizations are pushing for delay or postponing non-statutory salary adjustment or merit increase. And also, we've seen organizations are considering introducing more, kind of canceling some of the non-statutory base salary adjustment. So definitely there's a little bit more inclination to move toward that. One thing we have not seen much changes at all, if anything, minimal changes, is any kind of involuntary base salary reductions, even if it was allowed by law. So there's definitely, some degree of making sure that the employees are not negatively affected by this pandemic, this crisis. So there's definitely a shift in terms of organization taking some action within a month's time. The other aspect I want to mention is about this is hazard pay. We've seen organizations, this became a very hot topic maybe a month or 2 months ago, as a lot of workers are exposed to the potential hazard particularly health workers dealing with the crisis. We've seen actually a slight shift as organization now, putting it as a temporary measure. And we've not seen an uptick in organization offering hazard pay of anything, a slight adjustment and reduction in terms of providing that. Okay. I'll stop there to see if there's any comments or any questions on that. Okay. Let me move on to the long-term ranges. What are some of the key changes? And I won't go through all of them, but I think what we do see is, number one is there's no questions about companies really are re-looking at and reassessing the workforce strategy, particularly looking at one is increasing more flexibility for remote workers. And I think this is probably a wake-up call, quote unquote, for a lot of organizations in terms of making sure that technology infrastructure are in place in order to anticipate, but also moving toward a different kind of workforce environment. And technology is definitely going to be one of the key aspects. The other element is to introducing more flexibility in the work arrangement. We've seen organizations that maybe traditionally, have been more conservative in terms of increasing flexibility. This is definitely a time where, there's a push to explore and really looking at other alternatives and providing that option to the employees. At the same time, still managing, in terms of the workforce effectively. So that's from a workforce strategy
more virtual
shifting.
Workforce. And in fact, some of the tech companies have gone forward and said, we're going to let everyone work virtually. How will that impact compensation? I mean, you're not going to be paying everyone Bay Area premiums if they're living in Omaha.
Yep, no, and that was going to be my next point, Janet. Thank you for that. I think from a compensation, moving to a more virtual workplace definitely will impact the way how compensation is based. Most organizations in the past looking at compensation primarily assuming that the majority of the workforce is going to be at headquarters or going to be on site. Well, this is changing now where companies, are looking at introducing more what we call geographic pay differential. Now, I just want to back up a little bit in saying that geographic pay differential is not a new concept. It is already in place to recognize, where your office are based and where the concentration of the employee. But now we're moving off completely to the work kind of remote sort of virtual workforce. Then the office is no longer, the physical location, but it's actually a home office. And so companies are really reassessing that again and making sure that is it going to reflect accurately, for the employees by recognizing that most of them are now do not need to or don't have to work in headquarters, which tend to be more high-cost locations. To what extent is this, applied to all of the employees? I think what we see is that for the majority of the company, it would apply to all the employees. However, there are some recognitions is that maybe for certain executive or senior management level, you will continue to recruit these talents at the national or global level. And therefore, particularly in the U.S., you need to still be able to pay the premium regardless of where the employees is paid. So that's the kind of, considerations that a lot of companies still looking into and making sure that, the degree of application of this geographic pay differential.
Laws in countries where if we start to see that kind of disparity in pay between people who work in the office versus people remotely, and to see how, I'm speaking this from a lawyer's perspective, but to see how courts react to that, and if that that can be a differentiating characteristic to actually justify different pay for equal work, you know.
Yeah, yeah. It's true, right? And we don't know for sure what's going to happen and how's that going to impact long term. What I can say that in certain a number of countries, there's already that kind of geographic recognition. You know, for example, in China, you have pay structured very differently for tier 1 city, versus tier 2, and then 3 and 4. U.S., we do have cost of living adjustment, which impact the pay differential. But it's true. If it is now become a reality going forward, how is that going to impact, from a legal perspective? And I'm not sure
Thanks so much, Kathy, for educating us on the comp issues. I don't want to give benefits short shrift here, so I'm going to turn it over to Carl. And a matter of fact, I've already gotten a question, a benefit-related question in based on your slide, but I'm going to address it to Carl. How are we seeing voluntary retirement or retirement incentives shaking out in these economic troubling times?
Okay, I hope you can all hear me. I've got quite a bad connection, so those that are on camera, you'll have to signal to me if you can't hear me anymore. But so first of all, great to meet you all. And yeah, I've just got one slide here which covers the 5 sort of mid to long-term trends that we're seeing. Unfortunately, there's probably more bad news than good news, although as we walk along the slide, there are some areas that are probably driving some significant change that we've all been hoping for. So first of all, I'm going to cover off some underwriting issues. Unfortunately, as we're seeing a lot of excess deaths around the world. At first, there was a hope that coronavirus would only impact non-working age people, but obviously as it's evolved, that's not the case. So as we speak to insurers, we're starting to hear a lot now about mortality rates increasing, and therefore we can expect premiums to go up as well when we talk about life and accident insurance. Similarly, when we think about medical, as we're seeing around the world, really in many countries you can only access emergency coverage at the moment. So you're seeing a lot of people not going for appointments, not visiting the doctor. So unfortunately we see and expect to see a lot of much later diagnoses of quite serious conditions that will then lead to unfortunately increased medical costs, but also push up mortality rates as well. And then the other one that's linked directly to a lot of the lockdown is really the sort of mental health issues, that without seeing friends and family, being stuck at home, but also musculoskeletal issues. I think it's improved now, but when this all first happened, every time I joined into a video call, you'd have at least half the people hunched over their kitchen table, building up a bad back issue. So we really do see some significant issues related to both mental health and musculoskeletal. So that unfortunately is going to flow through as medical and also unfortunately disability claims as well. The other one I will point out here is declines in the financial stability of insurers. This is just to keep something to keep an eye on. Obviously firms like Aon and others, we're keeping a very close eye on this, and this is related as much to the capital markets as it is to coronavirus. But as you can imagine, stock markets went down, a lot of capital shifted, and insurers that weren't particularly strong before may well now be looking at bankruptcy. So tactical piece of advice, keep an eye on those, and work with firms like Aon who've got teams that are looking at all that for you to make sure that you're still with a financially stable insurer as you go through renewals. Increasing medical trend I'll touch on quickly, and this is more related to the cost of medical services, and really 2 things to call out here. One is the fact that around the world there's been a scarcity of medical resources, both people, treatments, equipment, and that's pushing up, as you can imagine, the cost of medical services. You're also seeing salary increases to healthcare professionals around the world. That's going to push up those costs. And then secondly, in many parts of the world, particularly if you look at Russia, parts of Africa, and certainly the Middle East, you've seen huge currency depreciations against the dollar, and many of their equipments and medicines they buy in US dollars, and therefore it's significantly pushed up the cost of those treatments locally. So again, unfortunately, we're going to see increased medical trend coming through in the future. Janet, stop me when you want me to address any questions, or I'll try and go through the pillars and then pick up some of the questions that we've had.
I hope you can address the retirement incentive question about companies looking at voluntary retirement incentives.
Yeah, and I'm looking for that question here. I haven't seen that happening in the marketplace. And in many markets that around the world that often wouldn't make sense. We're certainly seeing, actually, going back to some of Kathy's discussion, the options being given to employees to temporarily halt their retirement contributions to offset any reduction in pay or to maximize their take-home pay.
Yeah, I think Kathy, Janet, I'm sorry. We are seeing employees kind of voluntarily, you're seeing companies maybe try to incentivize employees who are at or near retirement age to go forward and actually retire. And depending on the industry, some employees are voluntarily electing to retire because of the potential health risks. Right?
Yeah.
You have at-risk people. Depending on the country, there may not be, protections that say like an at-risk person can't, they still need to go to work or something. So employees are electing to voluntarily retire. I think one thing that we're going to start to see, severance packages, right? Severance packages have always been centered around cash. But now I think employees are going to be looking for benefits continuation as a real component. And I think in a lot of ways that could provide some issues for companies because, where you're not talking about state-sponsored insurance policies, but supplemental plans, where the policy may actually require that the employee is an active employee to be able to cover, to continue coverage. So like here in the U.S., we have COBRA, right, where an employee has the option at their cost, and a lot of times companies will pay that out of their pocket to, pay the COBRA coverage for the employees. But other countries in the world don't have that same regime. So one, will something like that go into place? And two, what ability do companies even have to continue benefits coverage for employees? People that are no longer employees.
Yeah. And the US is quite unique because of the healthcare system. In many other countries, people will fall onto the state system, which they can access and provides reasonable levels of coverage. I just want to cover off the point around well-being, and I will tackle the other questions actually in here. So well-being is a really positive one. I think we've heard and seen a lot of well-being before coronavirus, but this has really been a big change. We're seeing many companies for the first time realizing how dependent their business success is on the health of their employees, because supermarkets, hospitals, all sorts of organizations suddenly don't have people at work. So we're really now seeing companies think about benefits as a way of keeping employees healthy, and they're starting with that premise. What benefits do I need to offer to ensure my employees and their family are healthy and at work? I noticed here there's a few questions around vacation and the rollover of vacation. These are really good questions. Obviously people haven't been able to take annual leave because they've not been able to travel, so a lot of people have been cancelling annual leave and looking to roll that over. Many countries now, the tax rules don't really support rollover of annual leave. There's not much that can be done about that. So what we've seen is, it's up there on one of the first bullet points, is offering employees the opportunity to combine various leaves, carer leave, as well as sick leave in some markets, to make sure that they have a holistic leave package for the next 12 to 18 months, and they can use that for multiple sources. We are also seeing some people change their flexible benefits rules for next year, where enrollment is coming up to allow people to sell leave back, But more importantly, I think, is the link to well-being, which is companies saying, well, actually, we think it's really important, given the stress we're all under, to make sure that we can take some time off, even if we can't physically take a vacation. The other piece in here is around voluntary healthcare. I saw a question around that. One thing I would add around voluntary healthcare is the increasing use of telemedicine. And again, this is an interesting trend. People have thought about this at the moment as a reaction to the fact that nobody can get to an outpatient. But we do see that actually this is here to stay, and the usage of telemedicine is only going to grow into the future. And at the moment it's quite expensive, but we see a lot of insurers in many markets around the world now looking to roll out systematic and structured telemedicine, where that is your first port of call rather than sort of
Well, Carl seems to have frozen here, and he's been talking about telemedicine. And in my experience with my member councils, telemedicine has been used by many global companies in multiple countries, even those who are really not used to it. So
yeah.
It's become very much a prevalent practice.
Yeah, I know.
Welcome back, Carl.
Sorry, Jen, I think I got cut off there for a minute, so sorry. I appreciate we're almost at the top of the hour now anyway, so you want to take it back?
I will take it back. I want to thank you all for joining us today in our Global Comp and Benefits Watch. If you're interested, we've got lots more webinars to keep coming at you. Some of the more timely ones coming up are one having to do with student loan benefits. That's later today. Repurposing governance after COVID-19 is coming up this week. And then finally, we've got some corporate citizenship webinars coming up as well. These are all from the Conference Board, and you can look on the Conference Board website for more information. Again, there is an executive compensation conference series starting next week, and this is in lieu of the Conference Board's normal executive compensation conference. So we're going to a special COVID, we're all at home series where we'll have a series of speakers and interactive sessions for that executive compensation group. And finally, there is the Environmental, Social, and Governance Center sponsors the News and Views, and you can see you can tune right in there to get some more information on that as well. And thank you again for joining us today at our webcast. We really appreciate all of you for joining in, and if you'll complete the survey up there, we'd appreciate it, and hope to hear from you soon, and everybody stay safe. Thank you again.
Thank you.
Thank you.